The tax legislation, rules and rates applying to inheritance tax makes for quite a large book. This is both a blessing and a curse. It means you must tread warily in considering your future liability to inheritance tax, as there are many factors to consider. And it is easy to make mistakes and end up paying more tax rather than less. But conversely, it also means you have many opportunities to reduce your future tax liability. And this starts with making sure you are using all the possible exemptions that are suitable for your circumstances and position. If you are married or in a civil partnership, then you should check how your assets and liabilities are structured between you and how these are going to be divided upon death. You should ensure your will is up to date and correctly worded to support your wishes. One of your allowances is the residence nil rate band, the extra allowance which can be used against your property. But this is riddled with complexity. For example, it can only be used against residential property left to direct descendants, and the value of this exemption reduces once your entire estate is above £2 million. So, in some cases, this allowance is easily lost, and for a couple, if it is completely lost, an extra £140,000 of inheritance tax would be payable, based on the current value of this allowance and the current tax rate. How your investments are structured can also make a difference. For example, if you have money in ISAs, these could be subject to inheritance tax, but money in a pension might not be. Similarly, if you use investments that are subject to business relief, then these can become exempt from inheritance tax once held for just 2 years. The answer to utilizing available exemptions favorably is to get advice and have an effective plan. There is much that can be done to effectively bring down an inheritance tax liability.